Hi there, welcome back. In this video I am gonna explain one of the very important financial statements under IFRS. That's gonna be IAS 7, statement of cash flows. As you are aware that there are four main financial statements recognized by IFRS. These are the statement of financial position, the statement of profit or loss, and other comprehensive income, the statement of change in equity, and the last one is the statement of cash flows, which I am gonna talk about it in this video. Before I go any further, by the way, my name is Tom and I am a financial auditor and IFRS instructor. I create free courses on IFRS, International Financial Reporting Standards, accounting, and Microsoft Excel. You are welcome to check my YouTube channel and my website at www.tomeducate.com. If you believe this video could help you, please share and subscribe. By doing so, you are helping others too, isn't it? Okay, let's see the overview of International Accounting Standard 7 cash flow statements. The cash flow statements was issued in 1977 by the International Accounting Standard Board and reissued in 1992, then followed by amendments. The effective date of this standard was 1st of January 1994. So here let us see what the function of cash flow statements is. Firstly, it requires entities to present the change in cash and cash equivalents in the form of a statement of cash flows. Secondly, it explains the elements of cash and cash equivalents and there's cash movement. Thirdly, it prescribes the cash flows as either operating, investing, or financing activities. Lastly but not least, it provides two methods in reporting of operating activities, direct and indirect methods. We shall explain more later in the practical example. Keep watching, please. The cash flow statements comprises three main activities section. The first section is operating activities section. The operating activities section reflects the performance of entity during the financial year or periods. These are sales of goods or providing services. Another source of cash in could be from royalties, fees, or commission that entity would generate from operation. On the other hand, the elements of cash out under operating activities either to be paid to suppliers in the sort of purchasing goods or receiving services and paying salaries to the employments of the entity. We have finance costs are cash out and investment income cash in, as well as income tax and interest paid should be deducted because they are cash out. This is a summary of operating activities. You will understand more in the practical example. The second section of cash flow statements is investing activities. Under the investing activities section, an entity is required to show long-term economic benefit transactions, such as acquisition of property, plant, and equipment, and intangible assets. The PPE items shall stay more than a single financial year, and their costs fall under cash out and should be deducted. However, a business might dispose or scrap some of its previously acquired PPP item. The gain from the disposal of PPE items are considered as cash in. Another probability under investing activities is equity and debt instruments. Imagine dividends are received, so these would be cash in and increase net cash and cash equivalents. The last scenario under investing activities would be advances and loans to other parties. If a company gives long-term loans or advances to its related parties or staff, it will decrease cash and should be cash out. But be careful, if these activities are part of your day-to-day business activities, you should put them under operating activities. Exactly what is happening in the financial institutions. Take an example of banking industry. The third activity is financing activities. This section contains rights or shareholders of the entity. This could be the issue of shares and equity instruments, any sort of loans, notes or bonds received in course of financing activities. Lastly, reduction in lease liability shall decrease net cash. The closing balance of cash and cash equivalents showing in the statement of financial position at reporting date must match the net cash. Cash under IAS 7 means cash on hand and cash at bank. But what does mean cash equivalents? These are short-term instruments. Now let us see the format of cash flow statements. Here I'm gonna use indirect methods, which is easier and common one instead of direct methods. However, if you wish to use a direct method, the difference only on operating activities. Under indirect method, you shall start from income or loss before tax, while under the direct method you start from adding sales or service and deducting cash paid out to reach net cash from operating activities. There are important things you should not forget while preparing your cash flow statements or CF statements. These are the name of entity, the name of reporting entity, address, reporting periods or reporting year, and reporting currency. Here I have dollars currency. So the format is start by cash flow from operating activities, and then we have notes, then the current reporting year, then we have comparative year. So as I said before, the profit or loss before tax, this year we have profits, previous year we had the entity generated loss or had loss. So then we add finance cost. We need to add the finance cost, in both year. Then we have the investment income must be deducted because it was the increase and should be deducted. Then we need to add back those non-cash elements. The non-cash elements are the depreciation, amortization, and then we have provisions. If we book any provision, such as provision for employment and the provision for the slow move of goods, if an entity generated any profits from the selling back the property, plant, equipment items, so any gains must be deducted from the operating activities. Then we will have increase or decrease in capital accounts. This would be inventory. So inventory, if there's increase in inventory, we should deduct that inventory or increase. You need to go to your financial position to calculate the inventory, the change in inventory. It means last year figure minus current year figures gives you decrease or increase. If the amount is decrease, you need to add. If it is increase, you need to deduct that amount as is showing here in the format. Then we have account receivables. Account receivable, the same scenario, previous year minus current year from the financial position figure gives you the current figure. Then we have other receivables. These other receivables could be prepayments and any sort of the current deposits, current security deposits. All those other receivables should be reported here. And then there would be due from related party, would be the same scenario. Then we have increase or decrease in accounts payable. This is trade payables. So trade payables, if decrease, we need to deduct the decrease and we shall add the increase. So I have here accounts payables. You need to go to the financial position. From the financial position, current year figures minus last year or the previous year figures will give you the figures or the amount. If it is increase, you need to add. If it is decrease, you need to deduct that amount. Then we have also others payables, and we have also people due to related parties, same scenario. Then we will reach to the cash from or used in operation activities. Cash from, if the amount is negative, would be cash used as is showing here. If it's positive, would be cash from. So the total of this till here will give us either cash from or cash used in. Then we need to deduct interest paid, and we need to deduct income tax paid as well. And then the total of all these figures gives us net cash from or used in operation activities. If it is negative, would be the net cash used, and if it is positive as is shown here, would be net cash from or net cash generated from. So the second section is cash flows from investing activities. Cash flow from investing activities is started by proceeds from sales of property, plant, and equipment. If an entity sells any items of property, plant, and equipment disposal, we need to add them here as cash in. Then on the other hand, if in case there is any purchase or acquisition of property, plant, and equipment item, we should deduct that amount because it is cash out. Then we have interest received. If any interest received, we should add them. It is addition to the cash in. Then we have dividends received. If an entity receive any dividends, that would be cash in and should be added. Then the total of these would gives us either cash, net cash from, or net cash used from investing activities. Lastly, or last sections would be cash flows from financing activities. Here we have some elements here. Issue of equity shares. Imagine shareholders issue or new share capital or increase the existing share capital. It would be cash in, additional cash, and then would be the addition for the financing activities. Then we have if the entity repayment of any long-term borrowings, so it would be cash out. We need to deduct this amount from our financing activities. Then at the same time, if we receive proceed from long-term borrowings, if we receive any sort of long-term borrowing, we need to add that amount back to financing activities. Then lastly, if in case we paid or any dividends paid, we need to deduct that amount because it is cash out. So then we will reach to the point of net cash from in financing activities, either net cash from or use it in financing activities. Lastly, we should calculate net increase or decrease in cash or cash equivalents, cash and cash equivalents. It means the total of net cash from operating activities plus net cash from investing activities plus net cash from financing activities will give us net cash increase, net increase or decrease in cash and cash equivalents. Then we need to add the cash and cash equivalent at the beginning of the year. How do we calculate the cash and cash equivalent at the beginning of the year of the period? This simply equal to closing balance of the cash and cash equivalents from the previous year. If there is no comparative figures, just leave this as 0. Then you will reach to the point of cash and cash equivalents at the end of the year of the periods or the periods, which is net cash and cash equivalent generated or increased plus cash and cash equivalent at the beginning of the period will give you the cash and cash equivalents at the end of the period. So this amount must match or equal the amount that is reflecting in your financial position or at the bank. So how do we calculate this one? If you go to the financial position, the cash and cash equivalents would be cash on hand plus cash at the bank, and cash equivalents any sort of short-term instruments, minus in case you have bank overdraft. So you need to deduct that bank overdraft to reach at the point of this amount must equal. If your cash amount, cash and cash equivalents balance is not matching with the cash and cash equivalents at your financial position, that means there is something wrong and you need to correct and find out the incorrect points. Thank you so much for watching, and please do not forget to share and subscribe this video so others can get benefit. Bye bye.